Hi everyone, hope you're all doing well, and today I'm going to share with you 3 stock market mistakes that I made, and then hopefully with me showing you these mistakes, then you guys won't make them mistakes going forward. So yeah, I hope it's a little bit useful for you guys. If you could smash the like button, if you're new and you find this video helpful, make sure to subscribe, and we'll go through these 3 stock market mistakes that I made. So number 1 is Shopify. So this came onto the stock market, I believe it was 2016, and then it kind of kicked on, and I kind of caught my eye back in like 2017. And back then when I saw Shopify, I was actually using the website and I knew how good of a platform this company had. I thought, well, you think about the e-commerce is going to grow huge for Shopify, and just in general a massive TAM. You think about the amount of online entrepreneurs now setting on e-commerce websites. Shopify was ideal for them compared to something like Amazon that was just kept putting the fees up. I thought Shopify is really great because you track your inventory, and as well as having your marketing in there, analytics in there, designing your own brand. I thought it was just absolutely amazing, and I thought, you know what, it's a competitive space, but Shopify's product for me was hands down better than everyone else's in that space. And I thought this space is just going to get hotter and hotter as the years go on. And I used the website myself. I thought it was absolutely fantastic, and the management was great, everything with the company was great. They're growing revenue at a fantastic rate, amazing balance sheet. And I looked at the company and I thought, you know what, this is one I really need to buy because it has so much potential. But the one thing that put me off Shopify was its valuation. It kept going up and up and up. There was a period where it kind of flatlined for a little bit, but even then, the valuation that it was trading at was very, very high. And sometimes that has served me very well. One of the best stocks I've invested in was back at Tesla when it was $40 back in 2019. I looked at Tesla and I was like, this could be like the game changer in the EV space, which is going to blow up. And back then I believe Tesla was at like a price to sales ratio of like 4 or maybe even 5. And that's just crazy because even now it trades at like a price sales ratio of 16, and that's after going up, how much it did in 2020. And, don't get me wrong, being very aggressive on like how the valuation is and making sure I'm buying a great company at cheap valuation has worked out amazing for me over the years. I made really good gains on buying cheap growth stocks, but Shopify was one that wasn't as cheap as what previous ones I had been buying. And I looked at Shopify, the valuation, some of the times the run it had been up on, and I thought, I love the company, but I can't justify the valuation. And every kind of like 6 months I'd go back in, the stock had gone up, thought the valuation is still expensive, never bought it. And it got to, pretty much this year where I finally bought Shopify, and I should have bought it so many years earlier. And I thought, you know what, this was an example of a growth stock that I was 100% confident this company was going to absolutely smash it, and it did. But the thing is this stock, since I was really interested in it, went up 1,000%, and I should have bought the company. And Shopify was a big mistake for me because I should have bought the company because I knew it would do amazing, and I just got hung up on the valuation. And what I should have done back in 2016, 2017, or even in 2018, 2019, 2020, is I should have just gone, you know what, the valuation might be a lot, but what I can do is just buy some shares, and then if it does go down, I can average in. And that's worst case scenario, and I still have an amazing company and the company performs amazing, and in a few years time I'll be laughing at being down 10-20% on a company that went up 1,000%. And that's what I should have done. I shouldn't have got too hung up about a valuation for a company that had so much potential. And I learned from that point of view that don't get me wrong, it worked out for me because I still made some really good gains on growth stocks. But there was a few stocks that I thought, if you ever see a company that you absolutely love, that the only thing you're caught up on is the valuation, don't worry about it too much, because even if it does go down, you can just buy more, and you get it at a cheaper valuation, you make more money. And I learned from that way from Shopify that if I ever see an opportunity that is absolutely amazing, don't get too caught up on the valuation. And that's one that I should have bought and I never did. And if I did, I'd be up a massive amount, up 1,000% on that company. And learn that one the hard way. Number 2 is cash. So when I started learning about the stock market, one thing that you kind of get taught and what is kind of pushed out there is that cash is bad. If you hold a lot of cash, what's the point? Because what happens is cash kind of stays the same value, and you could have had that money into stocks, and stocks keep going up and up and up, which is 100% correct. But that was kind of forced so much down you that you kind of got into the idea that you didn't want to have any cash and you just wanted to invest it all in stocks. And after a while, I kind of learned that cash is still very, very important, and you still want to have a lot of cash on the sidelines. And that kind of took me a little bit to learn that, okay, yeah, cash is bad and you want to have a lot of it invested. At the same time, you do need cash on the sideline. Because what I learned is very quickly that if you have all your money into stocks and stocks go down, if you don't have cash on the side, then you have no chance of buying these dips, when those are the best. Buying stocks on the dips is the best thing to do. And if you don't have cash, you can't take advantage of them opportunities. Them advantages to make them the best chance to make money in the stock market is by buying companies on dip. And if you have no cash, you can't do that. And I learned that, okay, cash piles are very important, and you do need to have cash still on the sidelines. Cash is king, and cash will be able to go buy you them amazing opportunities. And I learned that very the hard way, I guess, as I'm sure some of you guys might actually learn that the hard way as well. I don't think I've ever talked about that on the channel before. And as well as that, the one other thing that I learned very quickly with cash as well is that cash, when you have the stock market, what you do is you invest into companies, but that cash is going to be tied up with that company for maybe the next kind of 1 year, 2 year, 3 year, 4 year, 5 year. Your cash is going to be tied up, and you can't touch that cash. You know, you can make money going forward, but that money you won't be able to use again for a while. And with that kind of thought, what you have to realize is that, okay, if you can't touch that money, but there's new opportunities coming, what you need to do is actually have new cash coming into your stock market portfolio. And that needs to be probably through multiple income streams. The more cash you coming in, the more income streams you have, the quicker you build up your portfolio. So as well as having cash on the sidelines, the one other really important thing is also to have fresh cash coming into your portfolio. Because if, let's say you're buying DraftKings right now, DraftKings is a stock that might bring you in the rewards 3, 4, 5 years, but what you're going to do when the next opportunity comes up in 6 months' time, because you can't use that cash that's in DraftKings because that's still locked up, you need some fresh cash. And that's what I learned is, like, the more cash you have coming in, the more income streams, and that's how you really scale your portfolio, is having fresh cash coming in, as well as the benefits of having a cash pile. So that is number 2. And number 3 is your broker. I didn't really realize how important this was until probably last year, I believe it was. So I kind of used to use DeGiro all the time, and then I slowly moved to Trading 212 around about 2 or 3 years ago. I moved to Trading 212 because historically they were a CFD platform, and then they started focusing more on stocks. They then also brought out the ISA, which is really good for tax purposes. And I started using Trading 212 more, as well as DeGiro. But one thing that I really started to realize is that you can't rely on that broker, and I kind of neglected DeGiro, and then eventually I was like, okay, I need to get back into using DeGiro and Trading 212, because what happened with, if you rely on, say, just one broker, is that when it got into the peak CV times and the stock market was going down and down and down, what happened to Trading 212 is, and this might be a little bit more because it's more of a free platform, I guess, is the platform was going down pretty much nearly every day. And this is in the times where you want to be buying heavy. You know, there were stocks going down like 20% a day. And if that was ever to happen again, I couldn't have that where the broker was going down and I can't buy stocks. And that was a very common theme in 2020. And I realized, okay, I've got DeGiro on over here, but it takes a while for the money to go in there. And I kind of missed a couple of days while I was waiting the money going into the DeGiro, and Trading 212 was down. And I was like, okay, I should have been a bit more prepared and have 2 accounts ready to go in case one of them goes down, in case there's a big massive dip and everyone's flooding to get on the accounts. And that was something that I learned the hard way back there. Don't get me wrong, I still bought some really good stocks on big massive sell-offs eventually. But if that was like a 1-day event, or maybe even just a 2-day event where we had a big massive slump in the share price, if Trading 212 was to go down again, that I would maybe not miss out on some opportunities. It was very similar when Alibaba went down on Christmas Eve. That was a very hard one to buy. Pretty much couldn't get any orders through all day. And I learned that, okay, just relying on the one broker is definitely not a good thing, having 2 brokers there. And also think worst case scenario, what would happen if something happens to this broker as well. And also I learned as well, since I've been in the stock market, there's only ever been one company which I have ever sold at a loss. And it's a pretty good record, but I'll be honest, I really prefer the record when I said I have never sold a company at a loss before. I've always made money on every single investment I made. That was a track record that I was really proud to have. it kind of annoys me now that I have to say I've only ever had one company that I've took a loss on. And the fault really of why I took a loss on that company was once again down to the broker. And I shouldn't have relied on my broker to do this for me. I should have really managed this situation myself. And what I did is basically, the one company I ever sold at a loss was Cineworld, and I took about a 34% loss on that company, and I was actually up as well at the time. Basically, what came out is that the cinemas were delaying movie launches, and I thought, this isn't going to be great, especially with Cineworld's balance sheet. And I never had much money in it because I knew it was a high risk, high reward play. But I was like, okay, that could, the balance sheet that Cineworld have, this could cause a few problems. I thought, you know what, it's going to be a bit of a bloodbath tomorrow, but I'm up on my position quite a bit. So even if I do kind of go down, I'll probably still get out break even or a slight profit. Anyway, I set a sell order on my company. I was actually off to work. I set off to work at 7:30. Markets on the UK open up at 8 o'clock. Could not get on my phone until I think it was 10:30. So I thought I'll just have to leave it to do its own thing. So anyway, I went to work, kind of got to 10:30, looked at what had happened, and I took the big massive loss on Cineworld, and I was like, oh, how was that happen? And I looked at the stock was down huge. And I looked at the time of the order, and the time of the order that went through was about 9:30. So the stock market had been open for an hour and a half, and then they sold out my position rather than like 8 o'clock, 8:05. Obviously, there would have been loads of orders coming through, but it took a long time for me to sell my order. And I thought, well, that was my fault because I left the sell order on there rather than relying on the broker to put through my order for me. I should have just done that automatically and left that for me to deal with that situation in case the broker did this. And it's also why it's kind of a separate video why I'm not a huge fan of trailing losses as well, stop losses as well. And that's something that really, I thought, obviously the broker was kind of still going off my order, but I would have thought, well, if it sold off that much, if I was in control, I wouldn't have sold the stock. I would have gone, okay, that's just ridiculous, I'll just hold it now. And that's me kind of relying on the broker as well. So yeah, having the trust in the broker is something that I probably shouldn't have had. And that's something as well why it's really important to have two brokers, I guess. A little bit kind of going off topic there, but you kind of get my point as well, is that, I was relying on that broker to sell my order at 8 o'clock. Didn't happen, and because of that I literally got the worst price possible, and I should have really dealt with that situation myself and not relied on it. And that's something that I've always learned as well, about buying and selling exact orders as well. So yeah, I guess these are 3 stock market mistakes that hopefully you find useful as well, and hopefully you don't make the same. I think it's always good to go through some of the mistakes, and hopefully it saves you guys making them. Bit more of an education video, I guess. But yeah, hope you enjoyed it. If you could smash the like button, if you're new, subscribe, and I'll see you next video.